Good afternoon and welcome to HYROX's weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague Paul Tepsich, the founder of HYROX, who does some tremendous bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year, adding value to our portfolios while we have been able to reduce our exposure to risk. Our financial planner and wealth forecast specialist, Bianca Tomlinson, is also on the call. We'll have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us your questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we do each week, let's quickly recap our themes for 2016 before we get started on what happened last week. Now, our overriding theme continues to be that for 2016, financial markets will remain volatile. January and early February saw a spike in volatility, but markets settled thanks to continued central bank monetary stimulus. Now volatility is back in the picture as uncertainty levels are rising on a global scale with the debate over the fallout of Brexit. The U.S. economy represents 20% of the global economy, and over 50% of the companies in our benchmark equity index are domiciled in the U.S. So we spend a great deal of our efforts trying to determine how the U.S. economy will evolve. The heightened level of uncertainty hanging over the global economy at the moment has increased the chances of a global recession, and that could, well, be a catalyst that drags the U.S. economy down with it. Low inflation and deflationary pressures will likely continue until economic growth can return. Stimulative central bank monetary policy on its own has not yet succeeded in reigniting the economic growth. The geopolitical uncertainty has taken center stage. The fallout from the Brexit referendum and the rise of populism in developed nations, and especially the United States, will continue to hang over economic decision-making. There has been a flight of capital into safe government bonds, and bond yields have hit record lows, although they have, over the course of the last week, bounced a little bit higher. Equity market prices fell initially and then have bounced back following the Brexit decision, comforted by the greater possibility of more central bank monetary policy stimulus to combat the impact of this additional volatility. However, stocks remain expensive in terms of earnings and valuations. The price discovery and volatility will continue until a reasonable equilibrium is determined, but our comfort level of this asset class remains very low at this particular time. With no clear economic direction, businesses will tend to postpone investment decisions and consumers will postpone spending decisions until they can get a better sense of what to expect in the future. We are in a time when the risk-free rate of return is close to 0%, which means that to get the higher returns they want, investors are taking on greater risk, likely more than what we would consider to be wise. We think that this makes for a dangerous situation for investing and that caution should be the order of the day. Well, let's look at what has been driving markets over the last week. As we had projected, volatility spiked back to close to January and February levels a couple of weeks ago, but now it is back to its lowest levels on the year. This is a roller coaster ride that will likely continue into the future with more of those spikes coming in the not too distant future. Currently, we're well below the long-term averages, though. Well, the Fear and Greed Index has moved back into extreme greed territory, closing in on really high levels as all of the buying that has gone on in the last few days has been taken into consideration. The best time to buy, as far as we're concerned, is when markets are afraid. And we'll be patient to wait for that. Well, since our last webinar, our benchmark World Equity Index is up by about 3.5% and now up about 3% on the year. The German Xetra DAX Index was the best performer since last Tuesday. China's Shanghai Composite was the worst performer, even though it did have a positive reading. The Canadian TSX has been the best performing country index in the developed world this year. The Japanese Nikkei 225 has been the worst performing index. Buyers are testing the longer-term downtrend upper band of our benchmark all-country world indexes. Stock markets have rallied. Volume, however, remains light. Now, the one-year total return has been a negative 1.08%. The three-year annualized total return at 5.14%, and the five-year return of 5.3%. Sorry, the three-year total return 5.78, and the five-year total return 6.51%. And if you combine the equity and bond indices into a balanced scenario, the one-year total return has been 1.5% for a 60% equity, 40% bond index combination. Positive 5.61% over 3 years and 5.4% for 5 years. For less, 5.77 for 5 years. For a less risk-oriented 40% equity and 60% bond combination, the one-year total return has been a positive 2.8, 5.53 for the 3-year, and 5.40 for 5 years. When you are comparing the return on your portfolio for an apples-to-apples comparison, don't forget to subtract any fees and embedded MER costs from those benchmark returns. All our clients received their quarterly reports for the second quarter of 2016, along with this table of benchmark returns for comparison purposes. You should all be quite comfortable with your performance relative to the performance of the benchmarks, but if you'd like to discuss it in greater detail, please make sure you get in touch with us. We are always happy to take your calls and emails. Well, over the course of the week, U.S. high yield were up and U.S. government bonds were down as money moved into riskier assets out of safer assets. 10-year bond yields in the U.S. and Canada have bounced from their record lows, but still remain in extremely low territory. Oil and copper were up, and gold and natural gas were lower this week. Oil is lower, testing the lower band of the recent uptrend channel. Bloomberg Commodity Index continues its new uptrend, but is off of its recent highs. So the broad and diversified benchmark equity index, which we gauge the performance of our model and portfolio performance, covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. With over 50% of the companies in our benchmark domiciled in the U.S., we keep a close eye on what's going on there. First, to the political stage, we find Clinton picked up a little ground over Trump in the course of the last week. Now, in June, at their meeting, the Federal Open Market Committee members lowered their expectations for future interest rate increases from their March expectations. With the increased levels of global uncertainty and volatility, this may keep them on hold a little bit longer. It is our belief here at HIROC that an increase in interest rates in any manner will flatten the yield curve and potentially fuel the next U.S. recession. U.S. employment data was stronger for June, but it is only 1 month's data, although stock market participants believe it to be something somewhat more. Historically, these numbers can and likely will be revised. The key is the trend, and employment growth has been declining since late 2014. For the second quarter, GDP expectations have slipped to 2.3% as of today, with a decline in inventory investment. Elsewhere in the global economy, Brexit and the potential political and economic fallout continue to dominate the financial media. Unfortunately, it may take some time yet to determine what exactly will be the end result, but until then, there will be certainly be plenty of speculation and uncertainty. As was expected with the Brexit result, the British pound fell off of a cliff, but has stopped falling for the moment, and the UK will have a new Prime Minister tomorrow, Theresa May. According to her pitch to be Prime Minister, her approach is to slow things down and deliver political stability and economic certainty. She's rejected the idea of an immediate general election, and she has also ruled out triggering Article 50 this year, and that Article 50 is what would curtail the UK's association with the European Union. She says that Britain's negotiations need to be agreed and clear first. Well, following the Brexit referendum, the Standard & Poor's rating agency lowered the rating on UK government debt to AA from AAA based on a projection of economic growth lowered to GDP of 1.1% from 2.1%. The Bank of England Governor Carney, following the central bank's semi-annual financial stability report, said that there is the prospect of material slowing of the economy. The number of vulnerable households could increase due to a tougher economic outlook. The Bank of England will announce its latest interest rate decision on Thursday of this week. Global economic growth estimates have been revised lower across the board. And last week we discussed the precarious nature of the Italian banking system. The latest news is that in response to the market upheaval, the Italian government has been discussing with European authorities the possibility of state intervention to shore up the system, hoping to do it without imposing losses on some investors. Now, according to European Union rules, some investors must first take losses before state money can be injected in an ailing bank. But some loopholes in the rules could avoid such losses to preserve financial stability. Now, the International Monetary Fund has lowered its 2016 and 2017 growth forecast for Italy, saying the UK's decision to leave the European Union will increase uncertainty and will likely weigh on Italy's economic performance. In Japan, Prime Minister Shinzo Abe won a resounding election victory over the weekend, solidifying his support in the country's parliament and, in turn, raising hopes among stock investors that the government will soon enact new stimulus package designed to boost the country's sagging economy. This pushed the yen lower against the US dollar and pushed stock prices higher. Now in Canada, employment was unchanged in June. The employment rate declined 0.1 percentage points to 6.8% as the number of people searching for work edged lower. British Columbia was the only province with employment growth. The other provinces showed little change. Fewer people were working in construction, manufacturing, and the other services industry, while on the other hand, employment increased in accommodation and food services, as well as information, culture, and recreation. China's economic growth likely moderated a tad in the second quarter, and uncertainties at home and abroad are casting a shadow on the outlook for the world's second largest economy. The economy is expected to have expanded 6.6% from a year earlier in the second quarter of 2016, slower than the 6.7% on-year growth in the previous quarter. China's policymakers are facing a series of challenges from reducing industrial overcapacity to dealing with defaults on debt and rising risks from capital outflows and a weakening currency. We will see the latest economic data from China on trade and GDP over the next couple of days. So where is all this leading us? Well, let's see what the bond markets are suggesting. Yield curves continue to flatten, although yields have shifted slightly higher. German and Japanese yields are still close to that 0 4% line. As for equity markets, investors who buy stocks are buying into a stream of future earnings. Now, the price to earnings ratio represents a metric that we watch closely that is used to measure stock prices relative to earnings. The 10-year average price to earnings ratio is 14.3 times. The 12-month forward price to earnings ratio is currently at a rather expensive 16.6 times. At the equity market highs back in May of 2015, it was 17.1. We'll get the new numbers later this week as to whether we've taken that number higher. And not only are prices expensive relative to earnings, but there have been 4 consecutive quarters of negative earnings growth, and expectations show that the second quarter will be the 5th, with expectations showing negative growth of 5.4%, and earnings growth for all of 2016 has been reduced to about 1/2 of 1%. So it's hard to expect growth in equity markets when companies cannot grow earnings. However, obviously stock market participants are getting a little ahead of themselves right now. As second quarter earnings season begins, let's look at the estimated and the actual growth. Now, over the past 4 years on average, actual earnings reported by S&P 500 companies have exceeded estimate earnings by about 4%. During the same time frame, 68% of companies in the S&P 500 have reported actual earnings per share above the mean estimates on average. As a result, from the end of the quarter through the end of the earnings season, the earnings growth rate has typically increased by about 2.7 percentage points on average over the past 4 years due to the number and the magnitude of upside earnings surprises. So if this average increase is applied to the estimated earnings decline at the end of the second quarter, we would expect to see a negative 2.7% result for second quarter earnings. If the index does report a decline in earnings for the second quarter, it will be marked the first time the index has recorded 5 consecutive quarters of year-over-year earnings declines since the third quarter of 2008 through the third quarter of 2009. So what does it all mean? Well, for over a year now, we've taken a very cautious and defensive posture to investing, and it has been fortuitous for our clients and ourselves. Remember that we are investing in the exact same models and securities as you do. We remain defensive because we see few, if any, good buying opportunities at the moment. We monitor a great many metrics that help us to determine where there might be some value, but until we are convinced that there is value, we will remain cautious. With increased levels of uncertainty arising from the Brexit referendum, we are in no hurry to take added risk unless we see reasonable opportunity. Others may be willing to take on greater risk. We are not. Cash and cash equivalents have been and continue to be important defensive assets, so we are still carrying greater than normal cash balances in our models. If we can attain better than benchmark returns, having more cash and less exposure to risk, we are therefore attaining the best risk-adjusted returns. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, your goals, your risk tolerance, and time horizons. However, the ongoing research and analysis that we do at HIROC will dictate the minor adjustments in short-term strategy we make in our models, which we believe add value to the long-term performance. On BNN's market call back in May, Paul identified 3 top picks for our models. One of those was the 30-year Government of Canada bonds. Prices spiked post-Brexit but are off of their highs. But Paul's purchase idea is still up about 8.5% since May. Annualized, that's still a better than 50% return. So congratulations, Paul, on a great pick there. All right, what's up for next week? Well, we're going to get some data from China, as I said. Tomorrow we'll get the balance of trade, which will give us some insight into what's going on in their imports and exports. In Japan, we'll get May industrial production. Also in the Euro area, we'll get May industrial production. In Canada, the Bank of Canada will make their interest rate decision, and we'll see what they have to say in their press conference following about their concerns over Brexit. On Thursday, China's second quarter GDP and June industrial production, and then we're going to get an interest rate decision from the Bank of England. So very important to see what they will do or say with regards to the Brexit situation. On Friday, we'll get some inflation data from the euro area, and then a whole slew of data out of the U.S., June inflation, June retail sales to give us an idea of what the consumer was doing in June, and then we'll get June industrial production. Next week, we'll see some inflation data from the UK on Tuesday, and of course, our HIROC webinar, which we will hold again next Tuesday on July the 12th. Well, that's it for today's discussion. If anyone has a question at the moment, please feel free to ask it. All right, no questions today, but if you do have questions and wish to email us, we are certainly happy to get those questions. We want your feedback. We want to know what you like about these webinars, what you don't like, or what you might like to see us cover. So please absolutely feel free, especially if you're listening to the recorded version, to send us emails with your feedback. And as always, thank you very much for taking the time to tune in. Have an excellent rest of the week and a great weekend, and don't forget to tune in next Tuesday. But until then, this is Scott Tomlinson signing off.